Thank you. Hey, welcome to BSB. Today I've got Damian Jenkins from Fairway Capital with me. I thought it was about time that we brought a finance person. We've talked so much about business and everything else, but wealth creation isn't only a strategy for good times, it's a strategy for all times. Hey, Damian.
Hi, good morning. Yes, Kevin, certainly.
You can't just give me yes, no answers. This is a show.
I thought you were doing the intro. So, So I guess, in terms of thank you very much for being invited on to chat. So it's certainly from an investment perspective has been a very interesting time. And I think we're not out of the woods yet, but investing is long term. It's about diversification. It's about understanding what you're doing.
And we will talk about all of that. But first, I want to find out a little bit more about you and your background and about what's been happening in the markets, because they've been going wild, haven't they? They've been plunging and then raising up really quickly and then falling back a little bit, and they're all over the place. But we'll talk about that in a second.
For sure.
You've got a really interesting background for a financial planner. You didn't start out in financial planning, did you?
No, well, to be fair, I did start life on the London Stock Exchange as a young 18-year-old. So we're talking a long, long time ago now, in the good old days before what they call Big Bang. So I used to run around on the stock exchange. So when I was at university, I basically did that as a summer job and, learned a lot about investing then. Interestingly enough, when I finished university, I wanted to go into investing in finance, but we'd actually just had the 87 crash, so that gives my age away. And I was basically, there wasn't too much in my space, so I decided, or my mother told me that I'd become a chartered accountant. So off I went and joined PricewaterhouseCoopers, and there I was. So
And like every good son, you listened to your mum's advice. You went to PricewaterhouseCoopers. Did you ever meet Pricewaterhouse or Coopers? No, they're long gone.
No, they're that. In fact, when I joined them, they were Coopers and Lybrand, so even before PwC, and so quite a while ago. But yeah, effectively, I qualified as a chartered accountant in London, working in financial services a lot, but a great background, great firm. They were the largest accounting firm in the world at that time, and may well still be. I'm not sure, but
they still are.
Probably PwC is. So, so that was a great grounding, great technical skills. I stayed in finance. I basically became financial controller, financial director of different organisations, and effectively did accounting for my sins for about 20 years.
So you're a reformed accountant. So for your sins, you've then moved across into financial planning, and you're helping people with wealth creation strategies and that sort of stuff. And I did want to touch on the markets right now and how concerned should we be? And there's a whole lot of fear about people pulling their superannuation out of the markets and doing all that sort of stuff. Should we be concerned about all of this?
Well, I think it's important to always be concerned about markets, both good and bad times. Certainly, since the peak in February, we had the most significant correction in share markets, predominantly here and overseas. So, in the last 100 years, no share market has fallen as quickly. So our market fell 38% inside 3 weeks, whereas if you compare that to the GFC, that market fell 50% over 15 months. So that was dragged out for nearly a year and a half type of thing. So what we saw here and overseas was just so extreme. And to be fair, unless you had the crystal ball, it was very difficult to respond, But I think the reality was the top of the market in February, early part of the year, was the end of a long bull run from the GFC. So we had 10 years of markets pretty much going up fairly consistently for that length of time. And in reality, COVID just kind of turned up and became the catalyst for a bit of a recession or a bit of a downturn that was likely to happen at some point. So, markets weren't particularly overvalued, but they weren't cheap either. And obviously, that correction that happened in through to the end of March, in a way, is a good opportunity to get in and start another long run.
Cool. Now, I'm going to ask you to put your crystal ball on, and that's obviously the share market. Property has, nobody's interested in residential property going down, particularly the banks.
No, so I mean, residential property as an asset class it's an interesting thing because it's more than just an investment. It is people's homes first and foremost, and so it's an unusual type of investment. I think in certain markets here in Australia, Sydney and Melbourne, prices probably had grown quite aggressively. Over the last 30 years, interest rates have continually fallen, and that has made borrowing to invest cheaper. And the mortgages that used to be as high as 17 went to 10 to 7 to 5, and and you can get lending now starts with 2% sort of thing. So that has really driven that asset class. I think in Queensland and Brisbane, to be fair, it's probably been fairly okay, and it hasn't really impacted. But I guess the uncertainty and the unknown right now is how long the economic downturn will go on for, how much unemployment there will be, and really the stress on that sector will depend on economics going forward and people keeping jobs, really. So that's the key.
Absolutely. Now, since we're going to talk about crystal balls, and before we finish up, we will talk about your strategy for your wealth strategy for having a happy retirement. You've got a cooler way of saying that than I do.
Sure.
That was very cumbersome. However, before we get there, so we've talked about the share market and properties and all that sort of stuff. Where do you think these things are going? What do you think is going to happen?
Well, I think, different assets perform differently at different times. And so as an investment manager, it's my job to make sure there is diversification for people that suits the length of period of time they're investing for, how much risk, their tolerance to share markets and investing. There are assets that have accelerated quite strongly during this period. So commodities, gold, silver, gold is at an all-time high, and that's often linked to periods of uncertainty. Silver, I think, is as high as the peak since 2013 and so on. So, and other commodities around that. So there are assets that do perform well at different times. And
so
part of
going.
Sorry, what?
How's Bitcoin going?
Yes, I haven't followed that since it came off $20,000 a coin a few years ago. But I think that's not one of my recommendations for sure. So but I think and when I'm talking with pensioner clients as well, it's about making sure we've got 2, 3, 4, 5 years in cash or fixed interest. So during a period like this where assets have share markets have fallen, for example, they've got the liquidity in their defensive portfolio. And in fact, with those guys, there might be 60, 70, 80, but we're actually now we were buying into growth assets at the end of March and in April. So, but it's making sure that they're diversified, across all of their investments in the right way. So, for the long-term wealth accumulators, I mean, the US market fell 33%, our market fell 38%. What's interesting about the US market is that in the current calendar year, they're higher than they're at all-time highs again. But again, you really need to delve in a bit more, and there's 5 companies that are dominating that space. It's all the IT and the tech companies. So Apple, Facebook, Amazon, Alphabet, who own Google, Microsoft, they're up 35% this year. So, whereas so in the S&P, there are 500 companies in the S&P. The other 495 companies are all down 6%. So when you're investing, you really need to have a look and understand, what you're investing in, and obviously managers who do that day in, day out. So yeah, but it's about paying the right price for future cash flow earnings. That's when you're buying an investment, you're actually buying the future dividends and the future earnings of those organisations. And it's about making sure that even though they're great companies, you're not necessarily paying more than you need to or have to. So,
well, that was a nice little segue to let me tell people that tomorrow we're actually going to talk to someone about how to improve the value, or how people will value your business when you go to sell it, and how to improve that value. So that was a nice little. Thank you for that.
Sure. No, it's all good. Buying anything, it is, from an investment perspective, it is about future cash flow and, obviously getting your money back. If you put money in a term deposit at 1.5%, you're hopefully going to get your $100 back, government guaranteed and so on. But you're only going to get an income stream of 1.5%. So, so different assets offer different things, and share market's the same. People buy the banks because they have great dividends, but when the government tell them they can't pay dividends, then that's not quite as favourable as it was before. But ultimately, it's the long term, and once the economy normalises, banks can start paying dividends and so on. The value will return to some of those assets. So,
absolutely. So you've got strategy. You've got a 5-step strategy in relation to long-term wealth and having a happy retirement. So tell us a little bit more about that.
Yeah, so certainly when I visit or meet with new clients and existing clients, it's really trying to understand what the long-term income needs are for those clients, and at what point they're thinking about that. If you want 50,000 a year, 100,000 a year, that's really what you've got to build your asset pool and base up to be able to generate that for you. Because unfortunately, age pension is a backstop. It's an emergency buffer for people. A couple on a full age pension right now, just over 36,000 a year. If they need 50 or 60 or 70,000 a year, they've got to fund the difference. And for most people, the aim is to be self-sufficient and reliant. So it's understanding what your income needs. It's then saying, right, keep the math simple. If you want 80,000 a year and your pool's generating 5%, you need 1.6 million in assets to generate 80,000 a year. If you want 50 a year at 5%, you need $1 million. So, these sound like very big numbers, but it's really about what is your strategy, use of superannuation, business, personal investment, property, those, having a strategy in place and building all of those together to create wealth and basically create your number. So, and along that journey, people have to pay off their home as well. It's a real, it's a juggle. It's hard. It takes patience and commitment. But with commitment and compounding and understanding that you're in the right place, then you'll get there.
Well, that's it. There was that famous quote by Albert Einstein that compound interest is the 8th wonder of the world, and how
for sure.
You go. And you talk about that all the time with your clients, in the fact that if they started earlier, they would need less.
Yeah. My daughter, who's just started her first job at Domino's, she's a delivery driver and she's just doing 3 shifts a week. So I've kind of got her to put $20 a week into super. So that's $1,000 a year. She's going to get the co-contribution. She'll get $500. So her starting out at 18 is the same as somebody starting at 25. She only needs to do it for 7 years, and she'll have the same balance as somebody who starts at 25 and goes for 40 years. So I kind of drilled it into my kids, poor kids. But no, the earlier you start, the better it is. And, that it really is the aim of the game. And it doesn't have to be big. It just needs to be consistent and committed. And, a lot of it cheap. Huh?
And as you keep saying, don't panic, because, yes, the markets were down 38%. They've bounced back significantly from there. So where are they in relation to that now?
So, the Australian share market did drop 38% from the 20th of February to the 26th of March, something around that. So they're about 2/3 back. So the Australian market's about 60+% back from where it was. So admittedly, it's still got further to climb. It's just over that 6,200 points. It was at 7,200 points. But I think in the context of the last 100 years, there's been 12 periods in the last 100 years where share markets have fallen significantly. And on 8 occasions, they've fallen between 20 and 35%. And then on the other 4 occasions, they've kind of fallen from that 40 through 50, 60. So we saw that in the GFC, happened in the 30s, happened in 74 and 80s. So really this correction we've just had is consistent with one of those periods that you're going to get every 10 years or every 8 years. So, and really the catalyst, as I say, has been COVID, but there was something that was going to bring it along. So people have been shocked. There's no doubt about it, but we shouldn't be surprised, and there is a difference, but it's how you handle the shock, and it's about understanding, our process is very much looking at valuation. When share markets fall, that's actually when you need to be buying stuff, and when they're high, that's when you need to be getting out, and not the other way around. And I guess one of the disappointing things, and I understand why people have taken money out of super, because they're desperate to keep eating and fund their life and so on. But that 10,000 that's been pulled out has been pulled out at the bottom of the market. So effectively, it probably was nearer 15 or even higher, and vice versa. So, but I understand why people do it, and the government themselves, to be fair, have done a good job in assisting people with financial,
absolutely,
job keeper, job seeker, all of that.
So the key thing is, don't panic. If you're thinking about wealth strategies and retirement and that sort of stuff, the first thing to do is know your number, and then create a plan to build towards that number so that you can have a retirement. Your number is simply going to be about 5% or 20 times what you
want to say. Yeah, 20 times. So yeah, that's right. So, yeah.
Awesome. Look, Damian, thanks very much for coming on today. I really appreciate it. Been really insightful, both in what's happening currently, but also in that strategy about, hey, moving forward, having that balanced approach, not panicking, and not forgetting to get back in early. Hey, the best time to plant a tree, if you want some shade, was 20 years ago. The next best time is now.
That's right. And I think a lot can be achieved over the long term, and we overestimate what we can do in the short term. But if you do the right things and make the right decisions and understand where you're going, then you've got a path to follow, and that's what it's about. So, but it is difficult economic times, but actually out of those difficult times comes the best opportunity. So. Absolutely.
So as long as people aren't panicking, they're looking to get back in and get back into their superannuation and other investments. Now's probably a good time to do so. So thank you very much for your time today.
Good. Nice talking to you. Take care.
It's Damian Jenkins from Fairway Capital. Thanks very much.
Thanks very much. Cheers.